It's 2 in the morning. The blue light of your phone is the only thing lighting up the room. On the screen, a line on a chart is screaming upward. Your portfolio balance, a number you've stared at 1,000 times, just crossed a threshold you once dreamed about. Let's say it's $50,000. You started with 5. That's a 10 times return. Objectively, you've done it. You've won the game they said was impossible. But you don't feel like you've won. You feel a weird, hollow anxiety. You're not looking at that number, thinking about what it can buy or the freedom it represents. You're mentally already moving it into the next trade. You're scrolling Twitter, and someone is posting a screenshot of a $200,000 gain from a meme coin you saw but didn't buy. That 50 grand suddenly feels small, insignificant. The fridge in your kitchen might be empty, the gas tank in your car might be on E, but in this moment, those real-world problems and this digital fortune exist in the same emotional space. A feeling of lack. You're in portfolio poverty. My name is Sam, and for the last few years, I've been deep in the numbers and the psychology of why people who make life-changing money in crypto so often end up feeling, and sometimes actually being, broke. Let's start with a basic truth that most of us get wrong. We think making money will solve the problem of feeling like we don't have enough. It doesn't. It just creates a more expensive version of the same problem. This is because of a simple bug in your brain's wiring called the moving baseline. Your brain doesn't measure wealth in absolute dollars. It measures it relative to a personal, constantly shifting baseline. Think of it like this. You buy a token at $1, it goes to $10. You're ecstatic. Your baseline for that investment just shifted from $1 to $10. You are now in your mind a person who holds a $10 asset. So when it pulls back to $8, what do you feel? You feel like you lost $2. You feel poor. The actual math, the only math that matters to your net worth, says you are up $7, an 800% gain. But your emotional math, the one that dictates how you feel when you check your phone, says you're down. This is the hedonic treadmill. It's a psychological principle that says humans return to a stable level of happiness despite major events. You get a raise, you're happy for a month, then you get used to it. You buy a new car, it's amazing for a week, then it's just your car. In crypto, the treadmill is on hyperspeed. A 2x gain feels amazing until your new mental baseline becomes 2x, making a 1.5x gain after that feel like a loss. The goalpost isn't just moving, it's teleporting further down the field every time you score. Let's do the math on this with a real example. Imagine you bought 10 Ether when it was $1,000 each. That's a $10,000 investment. It's a big deal to you. The price goes to $3,000. Your portfolio is now worth $30,000. A 200% gain. Life-changing money for a lot of people. Your mental baseline has officially shifted. You are no longer a person with 10 grand in crypto. You are a person with a $30,000 portfolio. That's your new normal, your new zero. Now, the market does what it does. Ether dips to $2,500. Your portfolio is worth $25,000. You are still up 150%. You have a $15,000 profit sitting right there. But that's not what you feel. You feel a $5,000 loss from your new $30,000 baseline. Your brain interprets a 50% gain from your original start as a failure. That disconnect, that emotional math, is the root of portfolio poverty. And here's where it gets interesting. This feeling isn't an accident. It's actively manufactured by the environment you choose to live in. You think you're logging onto Twitter or Discord to do research, to stay informed. What you're actually doing is volunteering for a daily dose of manufactured scarcity. This is your poverty feed. Every time you open that app, you are exposing yourself to a curated highlight reel of the best possible outcomes. You see the one person who YOLO'd into a meme coin and turned $500 into a house. You don't see the 10,000 people who lost their $500 on the same play. Your brain isn't great at statistics, but it's amazing at comparison. So you make a great trade. You turn $1,000 into 10,000. You feel smart. Then you scroll. You see a thread about someone who made 50 times on a different token, and your brain, instantly and without your permission, runs this calculation. If I had put my original $1,000 into that token, I'd have $50,000, not 10,000. Psychologically, you just reframed your $9,000 profit as a $40,000 loss. Your feed just turned your win into a catastrophic failure. There's a theory called the adjacent possible. You're not comparing yourself to Warren Buffett, that's too far away. You're comparing yourself to the slightly more successful anonymous person in your Discord server. The one whose calls are just a little better, whose risk tolerance seems just a bit higher. That feels perpetually within your reach. Like if you just read one more thread, join one more private channel, you'll get there, but you never do. Because the moment you get close, your baseline moves, and their new wins are already further ahead. It's a race where the finish line runs away from you. The data on this is pretty clear. Studies from exchanges suggest the average crypto trader checks their portfolio between 15 and 20 times a day. Think about that. 15 to 20 micro decisions to feel either a jolt of scarcity or a hit of FOMO. Each one is a tiny reset of your emotional baseline. You're not managing money, you're feeding an addiction to a number. And the dealer is an algorithm designed to keep you engaged by making you feel like you're always missing out. So you have a brain that moves the goalposts on you, and you live in a digital environment that constantly shows you a better goalpost further away. This combination creates a specific and dangerous type of pressure. It's the feeling that you need to not just be profitable, but to times feel times as wealthy as your portfolio says you are. And that leads to the compound error. This is where portfolio poverty stops being just a bad feeling and starts actively destroying your wealth. The pressure to times feel times rich leads you to make riskier, more desperate trades to recapture that initial high of the win. You start chasing to recover a feeling, not to make a sound investment. Let's do the scary math on this. Say you start with a $10,000 portfolio. You're good, you're disciplined, you manage to 5x it to $50,000. This is huge success. But you don't feel wealthy. Your new baseline is 50 grand, and your poverty feed is full of people who turned 50 into 500. So you think, I need to get serious, I need a moonshot. You take half your stack, $25,000, and you put it into a high-risk, high-reward degen play, aiming for a 100x. Just pause there. That single trade, $25,000, is now 2.5 times your entire starting capital. Your risk exposure has inflated right along with your portfolio. Now, what happens if that moonshot fails? It goes down 50%. You lose $12,500 on that one trade. That loss, $12,500, is 125% of your initial $10,000 investment. Let that sink in for a second. You are still financially ahead. You have $37,500, almost 4 times your starting point. But you don't feel that. You measure from the $50,000 peak. You feel a $12,500 loss. That feeling of being down from your peak will likely push you to take another, even riskier bet to make it back. This is how success breeds not confidence, but a pressure that leads to irrationality. This isn't a hypothetical. A significant portion of realized losses in crypto don't come from initial investments going to zero. They come from profitable traders re-exposing their hard-won gains to absurd levels of risk. They're trying to solve an emotional problem, feeling broke despite having profits with a mathematical solution more profit. It doesn't work. The math might add up sometimes, but the psychology always loses. Think about Maya. She started with $3,000. Through a mix of luck and skill in the last bull run, she grew it to $45,000, a 15x. A miracle by any standard. But her mental baseline locked in at 45,000. When the market corrected and her portfolio went to 38,000, she didn't see a $35,000 profit. She saw a $7,000 loss from her peak. Feeling desperate to get back to that high, she put $20,000, almost all her profit, into a hyped new project that failed. Her portfolio is now $23,000. She is still up nearly 8 times from her start. She has a $20,000 profit. But she feels utterly broke and defeated because her mind is anchored to that $45,000 peak she once touched. Portfolio poverty convinced her that a $20,000 gain was a failure. Or take Alex. He's in a high signal alpha Discord. He made a great call, turned 5,000 into 30, a $25,000 profit. But in that Discord, he's surrounded by people posting 50x and 100x gains from pure degen plays. His 25,000 profit starts to feel like pocket change. He's not rich, he's a small fish. To feel like a real winner in that social group, to get that validation, he starts allocating bigger chunks of his stack to plays he doesn't even understand, just to keep up with the narrative. He's not chasing profit anymore. He's chasing the feeling of being part of the in crowd. He's trading for social status, and his risk management is the first thing to go. So if the chase is the trap, what's the way out? It requires a fundamental reframe. You have to stop measuring relative gains and start building absolute wealth. Relative gain is what we've been talking about. It's the 10x, the 50x, the comparison to the anon on Twitter. It's a game without end. Absolute wealth is something different. It's a number that means something in your real, non-crypto life. The escape from portfolio poverty is to create fixed, non-crypto anchors. Here's the practical step. Instead of saying, I want to 10x my portfolio, you calculate this. How much money, in stablecoins, would I need to cover my rent, my food, my basic bills for 12 months? That is your phase 1 absolute wealth goal. It's not a sexy number. It doesn't get you a Lambo. It gets you freedom from anxiety. Every dollar you move from a volatile asset into that stablecoin pile is a win. It's a brick in your foundation. It doesn't matter if the shitcoin you sold goes up another 10x after. You are not playing that game anymore. You are playing the my life is more secure today than it was yesterday game. You need to benchmark against your past self, not other traders. When your portfolio grows by $20,000, translate it. Don't think that's 20% of a 100K portfolio. Think that's a used car paid in cash. That's a year of student loan payments gone. That's 6 months of rent in the bank. This grounds abstract, flashing numbers in concrete reality. It rewires the connection in your brain between portfolio value and tangible life improvement. The data from traditional investing is clear on this. Investors who have clear, written financial goals tied to real-life outcomes report something like 70% higher satisfaction than those who are just chasing out performance, even if their returns are lower. They feel wealthier because they've defined what wealth actually means to them. It's not a number on a screen. It's security, options, peace of mind. This reframe isn't about being less ambitious. It's about being strategically selfish. It's about ensuring that your ambition to get rich doesn't accidentally prevent you from ever times feeling times rich, or worse, destroy the riches you've already earned. The most profitable trade you might ever make is to log off, define what enough looks like for you, and take deliberate steps to pull that amount out of the casino and into your life. So the uncomfortable truth is this. Your 10x gain didn't make you rich. It just raised the price of admission for you to feel rich. And that's a game designed for you to lose. Wealth isn't a number that goes up. It's a feeling of enoughness that you choose to build, one anchored, real-world dollar at a time.